herzlich willkommen aus dem Energiestudio Berlin zur Vorstellung des neuen Gas Market Reports der Internationalen Energieagentur. Heute mit der Analyse zum dritten Quartal 2025. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation hier bei die Gas- und Wasserstoffwirtschaft und ich freue mich sehr, dass Sie mit uns dabei sind. Europa hat seine Gasimporte zuletzt auf ein Rekordniveau gesteigert. Gleichzeitig liegen die Speicherstände rund 10% unter Vorjahr. Die Konkurrenz um LNG nimmt zu und auch geopolitisch bleibt die Lage angespannt, nicht zuletzt im Nahen Osten. Was heißt das alles für Europas Versorgungssicherheit im kommenden Winter? Dazu begrüßen wir heute erneut unsere Experten der IEA, Gergely, Molnar und Frederik Ritter. Herzlich willkommen und vielen Dank, dass Sie wieder bei uns sind. Die Veranstaltung wird aufgezeichnet, die Präsentation und der Link zur Aufzeichnung gehen Ihnen im Nachgang per Mail zu. Und wenn Sie Fragen haben, was wir natürlich uns sehr wünschen, dann nutzen Sie die Handhebefunktion oder schreiben Sie die Fragen in den Chat. Now I will switch to English. Welcome again, Gergely and Frederik. We are very glad to have you back with us. The world of gas remains in flux. Europe's storage levels are solid, but not quite where they were last year. The demand in Asia is recovering and the competition for flexible LNG cargoes is heating up again. And geopolitics, once more, is not staying quiet. Russian LNG is still flowing into Europe. Chinese buyers are rerouting US LNG and Washington is reminding us, not too subtly, that Europe should keep buying American. So we are very curious to hear what the IEA sees in the latest data and what it all means for the coming winters. Gergely, Molnar and Frederik Ritter, the floor is yours.
Many thanks for your kind words of introduction. My name is Gergely Molnar, gas analyst at the International Energy Agency. Today I'm joined with my colleague Frederik Ritter to present the findings of our latest quarterly gas report, which has been just released yesterday. And it is available free of charge on our website, iea.org. Here on the front page, we have Gaslog Glasgow, an LNG carrier, which indeed took the first LNG shipments from the LNG Canada plant at the end of June to bring this first shipment to Korea. And today's presentation will be very much structured along the lines of the key findings of the report. First, we will have an overview of the global trends. Then we will focus on the European market developments. And then Frederik will give us a deep dive on Asia as well as the LNG outlook. The report provides a short-term outlook until 2026 and also includes a special spotlight on the Middle East. So I think that the starting point is to look at the evolution of natural gas prices. On this chart, we show how European and Asian gas prices evolved since the start of 2024. In light blue, we have Platts JKM, a key marker for Northeast Asia. The light blue line shows us the evolution of TTF, the European benchmark, and the gray area between the two is the spread. And I would like to make three short comments related to price developments. The first one is related to the absolute price levels, the second to the spread, and the third one to the volatility we see in the market. Then looking at the price levels, we have seen gas prices moderating down quite significantly in 2023 from their 2022 highs. And this trend has been quite prevalent until the first quarter of 2024. And since then, we have seen quite a strengthening in natural gas prices, both in Asia and Europe. With both TTF and JKM reaching a seasonal high of around $18 per MMBTU in mid-February of 2025. And we believe that this strengthening of prices has been very much supported by the tightening market fundamentals, a still tight supply picture, and unexpectedly strong demand, especially here in Europe. But we also have seen that natural gas prices have been going down quite steeply since mid-February, which has been partly related to the easing of fundamentals, but also to macroeconomic uncertainty. And then if we look at the very right hand of the chart, we see that the Israel-Iran conflict renewed quite some volatility in recent times. But I think that what is important to note here is that when we look at the average price levels in the first half of 2025, we see that TTF averaged 40% above last year levels, and JKM stood 30% above its 2024 levels. So we are still in a relatively high price environment, which has implications also on demand patterns, especially in the more price-sensitive markets. The second point relates to the spread. If we look at the TTF JKM spread in the first half of 2024, we see that JKM was trading almost $1 per MMBTU above TTF, which indeed enabled stronger LNG flows towards the Asian markets. Now, the situation is very different when looking at H1 25, when we see that the spread practically disappeared. And on a netback basis, Europe has been more attractive to many LNG suppliers, including the United States. And this also explains the stronger influx of LNG this year to Europe. And the third point relates to price volatility, which in the first half of 2025 stood 70% above its historic levels on the TTF months ahead prices. And this is partly due to the geopolitical tensions we see on the market, including the Middle East crisis. And I think that the conflict between Israel and Iran has been a reminder how crucial is the Middle East for both regional and global gas supply security. The Strait of Hormuz alone accounts for approximately 20% of global LNG trade, and its importance is set to increase in the coming years with the North Field expansion projects in Qatar and with the commissioning of the Ruwais LNG export plant in the United Arab Emirates. As we can see on the first chart here, most of the volumes via Strait of Hormuz are destined to Asian markets, more than 80% of the volumes. But it is important to highlight that any disruption of trade flows would have an impact on all LNG importing markets, and the supply shock would spread across all these markets. When we look at Israel, its role as a key pipe gas supplier both to Jordan and Egypt has been growing in recent years. If we look at the first 4 months of 2025, we see that Israel has been accounting for approximately 15% of Egypt's primary gas supply. And what we have seen is that when during the conflict, Israel had to shut its production at some of its fields, and consequently had to cut piped gas deliveries to Egypt. This had also consequences on the fertilizer production in Egypt, highlighting the intimate link between gas supply adequacy and food supply security. And we should also note that Iran is a very important regional pipe gas supplier both to Iraq, but also to Turkey. In the first 4 months of 25, Iran accounted for roughly 7% of Turkey's primary gas supply. So at the agency, we continue to closely monitor market developments in the Middle East and beyond, recognizing the very important role of that region for global energy and gas supply security. Now, I think it is worthwhile to note that despite all the volatility we see in the market, the correlation between TTF and JKM prices remained extremely strong, actually at near record levels in the first half of 2025. And here, maybe just a broader comment is if we look at the correlation between TTF and JKM between 2012 and 2016, it has been rather weak, averaging at just around 0.4. And since 2020, the correlation between TTF and JKM stood at above 0.9, indicating that these regional gas markets are increasingly interlinked with flexible LNG. And this also reflects, in a way, the structure changes in the global LNG market, including the growing share and role of destination flexible US LNG, which is key in strengthening the liquidity and the flexibility of the global LNG market. We have also seen the growing share of spot LNG, as well as the rising importance of portfolio players. Now, let us have a closer look on the market fundamentals. And on this chart, we are showing how the supply picture evolved in the first half of 2025. Global LNG supply increased by around 4% or at 12 BCM in the first half of 2025. And as we can see on this slide, that has been mainly supported by LNG projects in the United States. Maybe one project to highlight here is Plaquemines LNG in Louisiana, which alone accounted for approximately 2/3 of incremental LNG supply in the first half of 2025. But other projects such as Corpus Christi Stage 3, Freeport LNG, and Tortue FLNG in Africa has been also contributing to higher LNG supply. And in addition to that, we have seen the ramp up of the Power of Siberia pipeline, which delivers gas from Russia to China. And in the first half of the year, flows increased by approximately 25%, adding around 4 BCM of gas to the Chinese market. Now, this growth has been partially offset by the lower pipe gas supplies to Europe, both from Russia and Norway, translating into a decline of approximately 8 BCM. And in addition, we have seen that Europe's storage injections have been much more robust in the second quarter of 2025, which also contributed to the tightening of the global gas market. Now, when looking at the demand side, we see a clear slowdown, but also very varied picture across the key gas markets. I think that the headline figure here is that our preliminary data suggests that global gas demand growth slowed down to just around 1% in the first half of 2025. And most of the growth has been actually concentrated in Europe and North America. As we see here, in Europe, natural gas consumption increased by a rather strong 6.5% or 15 BCM in absolute terms. And this has been partially supported by colder winter temperatures, but also very much by lower renewable power output. In North America, first data indicates that gas demand increased by around 2.3%, and this has been mainly driven by the colder winter temperatures in the first quarter of the year. Meanwhile, in the power sector, especially in the United States, we have seen quite some gas to coal switching happening due to the higher Henry Hub prices. In Central and South America, the picture is very mixed, but both in Argentina and in Brazil, we have seen quite a robust increase in gas-fired power generation, as well as stronger gas use in industry, and this in a way supported the overall regional gas demand. In Eurasia, our estimate is that gas consumption declined by around 2%, mainly due to an unseasonably mild winter in Russia. And then when we look at Asia, our estimate is that natural gas demand declined by 1.5% due to a combination of factors, weaker macro fundamentals, but also the relatively high gas prices have been also incentivizing some gas to coal switching in certain markets. And Frederick will give us a much closer look to those dynamics in the second half of the presentation. Now, when we are looking at the future, and in particular to 2026, we expect that global LNG supply will accelerate. For the full year of 2025, we expect that LNG supply will increase by around 30 BCM, mainly supported by products from North America. And this growth is expected to accelerate to 7% or 40 BCM in 2026, its fastest expansion since 2019. And this relatively strong growth is indeed supported by a range of products which are ramping up their supplies. When we look at North America, we see the key projects contributing to that growth is, of course, Plaquemines LNG in Louisiana, but also Corpus Christi Stage 3, LNG Canada, which just started exporting its first cargoes, and also Golden Pass LNG Train 1, which is expected to start operations in the last quarter of the year. And then we expect Costa Azul starting operations in the spring of 2026. So outside of North America, the single most important project to look for is Qatar's North Field East expansion project, where the first train is expected to start in the middle of 2026, and then the project is expected to ramp up supplies throughout 2027, potentially 28. Also would like to note the Congo FLNG Phase 2 project, which is expected to start operations towards the end of 2025, and most of those volumes would be destined to the European market. And then last but not least, we have Pluto LNG Train 2, which is expected to come to the market in the second half of 2026. And of course, this would benefit primarily the Asian buyers. Now, altogether, 2026 will be a step change for the global gas market, marking the first year of the LNG wave. And it will be also a test on how demand responds to stronger supply growth, especially in Asia. Now, for the full year of 2025, global gas demand growth is expected to slow down from 2.7% in 2024 to just around 1.3%. And this is partly due to tighter market conditions, but also heightened macroeconomic uncertainty. And I think that one region we would like to particularly note here is Asia, where we expect that gas demand growth will slow down to just around 1%, its weakest growth since 2022. Now, as we can see on this chart, our expectation is that global gas demand growth will accelerate in 2026 to 2% and reach a new all-time high. And this is mainly because of improving supply fundamentals are expected to foster stronger demand growth, especially in the fast-growing and price-sensitive Asian markets. Gas demand in Asia is expected to expand by around 4% and account for around half of global gas demand growth. In North America, gas demand is projected to increase by around 1%, mainly supported by the power sector, some recovery in the power sector. And in contrast with that, we expect lower gas consumption both in the South American markets as well as in Europe due to higher renewable power generation. In Eurasia, we expect growth of around 2%, partly on the back of assuming more average weather conditions. And then when we look at the Middle East and Africa, the combined growth in those regions would be 3.5%, mainly concentrated in the power and industrial sectors. Now, with that, let us move to the European market. On this slide, we show how natural gas consumption evolved in Europe over the first half of the year. As mentioned, we have seen a rather strong increase of around 6.5% or 15 BCM. And this has been partly supported by colder winter temperatures. We have seen heating degree days up by around 10% in the first quarter of the year, which naturally supported stronger gas use in buildings, up by an estimated 5%. But the most important driver has been the power sector, where we have seen gas to power demand increasing by around 20% compared to last year. And this has been very much supported by the lower renewable power generation. The wind power output has been down by approximately 8%, mainly due to slower wind speeds in Northwest Europe, while hydro power generation was down by 12%, mainly due to lower hydro availability in South Europe. And these episodes of lower renewable power generation has been also highlighting the very important role played by gas-fired power plants in ensuring electricity supply security, including in markets with a growing share of variable renewables. In contrast, we have seen some decline in industrial gas use, mainly because of higher gas prices. Our estimated is that industrial gas demand in Europe declined by around 2%, and first data suggests that most of that decline has been concentrated in the fertilizers and the refining sectors. Now, when we speak about demand in Europe, I think it is also important to take into consideration for the injections into underground storage. As we all know, Europe closed the 2024-25 heating season with very low inventory levels, which were standing about 25 BCM below their last year levels. So in the second quarter of 25, we have seen a surge in storage injections, which were up by 36% year on year and translated into 7 BCM of additional demand. Now, despite these relatively strong injections, EU storage levels are still about 11% below their last year levels as of mid-July. Now, this slide shows us an overview of how supply fundamentals evolved in Europe. And I think that what is quite interesting to note here is that while Europe demand and storage injections increased sharply in the first half of the year, the region's pipe gas supplies declined in the first half of the year. The deliveries from Russia to the European Union dropped by around 45%. And we have also seen lower pipe gas supplies from Norway, mainly due to maintenance and some outages. And in addition to that, we have been receiving also less pipe gas from Azerbaijan via the TAP pipeline. Now, when we combine this strong domestic demand together with lower pipe gas imports and higher storage injections, this obviously increased Europe's call on LNG imports, which surged by around 25% and reached an all-time high of over 90 BCM in the first half of 2025. And the United States has been really playing a key role in supplying additional gas and providing flexibility to the European markets. US LNG supplies to Europe increased by around 45%, and the US alone accounted for nearly 90% of incremental LNG supply to Europe. And this, of course, reinforced the US position as Europe's largest LNG supplier to account for almost 60% of Europe's LNG imports. And what we see is that Europe's LNG appetite is expected to remain quite strong over the summer season. As mentioned, storage levels are still below where they have been last year, but also they are lower compared to their 5-year average. In addition, we expect lower pipe gas supplies coming to the European market, mainly due to lower Russian pipe gas deliveries. And in addition to that, we expect that Europe's or the European Union's pipe gas supplies to Ukraine will remain strong in order to support storage refill operations in the countries. And when we put together all these different elements, we see that there will be a need for a continued strong LNG imports into the European market. Our expectation is that over the summer season, so the April to October period, Europe's LNG imports will be up by around 1/3 or 25 BCM, what they have been in 2024. So when looking at the forecast for 25 and 26, for the full year of this year, we expect Europe's natural gas demand to increase by around 3%, mainly on the back of the strong gains we have seen in the first half of the year, and also assuming average weather conditions for Q4. Now, looking at 2026, this forecast projects that Europe's natural gas demand will decline by around 2% in 2026, mainly due to the continued expansion of renewables, which will weigh on gas demand in the power sector. We do expect some recovery happening in industrial gas demand, supported by lower natural gas prices, and we also expect some demand growth in buildings, assuming average weather conditions. But those increases won't be sufficient to offset the expected decline in the power sector. And of course, this means that Europe's LNG imports would marginally decline in 2026 compared to their 25 levels. And now I would like to give the floor to my colleague, Frederick Ritter, to move on to the Asian market. Thank you.
Great. Thanks very much, Gergely. Hopefully everybody can hear me well. So in this first section, let's dive into Asia first, and then we'll have a look at the LNG markets. Of course, as we've seen in the past, both of these elements are absolutely central to the shifts in global market dynamics that we see occurring in 2025 and 2026. So the next slide, we start seeing that Asia has been, or rather, I think it's best to start off putting into context and realizing that Asia has been the primary driver of global gas demand growth in recent years. Its share of global demand upside has fluctuated, of course, on an annual basis, but the region accounted for about 60% of the cumulative global demand upside over the past 5 years, just for context setting. And for this reason, what happens in Asia is a significant factor in defining global dynamics, and the 2025 or 2024 to 2026 period shows this quite well. So from nearly 6% growth in 2024, Asian demand growth is set to slow significantly in 2025 to just under 1%, as Gergely mentioned a little bit earlier. We see the stark shift on the slide that we're showing here. In the chart on the left, we see the evolution in growth rates. So the black number is Asia, and the number in gray is the global demand growth rate. With the expected slowdown in Asian demand growth in 2025, we see global growth dropping from close to 3% in 2024 to just around 1.3% this year. Again, echoing what Gergely was saying before, but I think it's useful to put China or to put Asia and global dynamics side by side to see the interplay between both of these. Now, China is the first factor to look at here. With economic headwinds having emerged in the later parts of 2024 and leaving their mark essentially on the full year 2025 growth dynamics that we see playing out currently. That's the green or the dark green bar that shrinks in 2025 in the chart. Progressive nuclear recovery in Japan is also key in turning around the slight growth trend that we saw in mature Asian markets in 2024. That's the light green bar in the chart. And of course, other Asian markets also have their role to play in this slowdown, with LNG availability playing a role in tempering growth in some of these markets in 2025, as we'll dive into a little bit deeper in a few slides. Now, if we look at the chart on the right, this gives us a bit more insight into the sectoral breakdown of shifting dynamics this year. The two sectors leading the way in demand growth last year are also the two sectors really behind this year's slowdown. So number one, weaker economic fundamentals are already hitting industry demand for natural gas, China being the key factor here. And the combination of renewable deployment, nuclear recovery in Japan, and relatively high global gas price benchmarks has scaled back growth prospects for gas and power generation across the region this year. In 2026, however, we do expect to see a clear turnaround in Asian demand dynamics, A bit later, I'll dive into the underlying supply side factor here, LNG liquefaction growth. But here, I think we expect the return of China as the region's main driver. We also expect a recovery in industrial demand as improving supply conditions work in parallel with an improving economic outlook. And as mentioned earlier, where Asian dynamics go, the world somewhat follows. We forecast Asian demand growth to recover to about 4.4% next year, helping pull global demand growth back up to nearly 2% in 2026. Now, in the next slide, I want to move to China because, of course, as we've mentioned, this is where much of our Asia story is unfolding. We're starting off here with a chart that we've looked at in the past. It's historical demand by sector and at a quarterly granularity. So after a period of strong growth and recovery in 2023 and 2024, a shift has clearly taken place. This is the part of the chart on the right. One key factor that I've already mentioned is the emergence of economic headwinds in the later part of last year. But over the winter months, what we see also is mild weather having played a role in scaling back Chinese natural gas demand growth. And in fact, we see that the downturn deepened in the first quarter of this year, and we estimate that demand fell by around 1% over the first half of 2025 in China. We expect these early 2025 dynamics to really condition the full year trend for China, but we do see a mild recovery emerging starting in Q2 of this year, supported notably by a less acute downturn in industry demand for natural gas, which itself is tied to improving economic prospects. Now, we've seen this downside risk emerging for China in China for a while, and we've continued to downgrade our 2025 growth outlook in our successive gas market reports. Our current views for Chinese gas demand growth to be at a little bit more than 1% this year, which is above the total Asia growth rate, but slightly below our global growth expectations. Now, in the next slide, we'll focus a little bit more on this outlook element for China. Despite what's happening in 2025, what we see is that China retains structural growth elements in its gas market. So that's something that's rather clear. Under the right macroeconomic conditions, under the right price conditions, we expect these elements to, of course, reemerge relatively quickly. So despite the significant slowdown in growth this year, we expect to see a return to growth of around 6% next year in 2026. So industrial recovery is number one here. Road transport, growing distribution network connections, these are all elements that are behind this renewed growth. And in our latest outlook for 2026, what we see is that China would once again account for about 60% of Asian demand growth and around 30% of global gas demand growth. It's taking that role once again and picking up or acting as one of the key motors of Asian and global demand growth in 2026. Now, let's also take a moment to focus on the supply side of the equation. In 2025, incremental supply from domestic production and pipeline imports is expected to be more than enough to cover demand growth, indicating that Chinese LNG imports are set to drop significantly. They're already down by around 20% in the first half of this year, and we expect the drop to total around 11% by the end of this year. So improving LNG import prospects for the rest of the year, but not enough to push growth in the Chinese market in LNG imports. Now, in 2026, the picture flips. Power of Siberia, the pipeline connecting with Russia, will already have delivered its upside in 2025. And while we expect domestic production to continue growing at a healthy rate, this will not be sufficient to cover incremental demand. And LNG is therefore set to play the balancing role again in China, but in the opposite direction as in 2025. With even more LNG coming to market in 2026, again, we'll see this in a couple of slides. We expect Chinese imports to return to strong growth, bringing total imports to a new record high in 2026. Now, looking at the chart on the right, we see this balancing role of LNG for the Chinese markets. The light blue line has made a number of directional shifts these past years. In 2022, we already saw a year-on-year drop in Chinese demand, leading to the country's first fall in LNG imports. This was also the year where European imports surged as a result of the drastic turndown in Russian pipeline flows, of course. And Chinese LNG imports then returned to growth in 2023, 2024, backing up demand growth in the country over those years. And now again, LNG is set to play that balancing role in the Chinese markets. And the flip side to this is that China is expected to be a key balancing element for the global LNG market, as we'll see in the next section that I'll cover. So what about Asian markets or other Asian markets? On the next slide, we'll have a little bit of a look at other markets in the region. Of course, as we've said, China has an overwhelming role in Asian demand dynamics, but it's not the entire story. Here we're putting India and the rest of Asia side by side, again, notably to show the different sectoral drivers behind these different markets, and to also show the relationship to LNG when thinking about their growth trajectories over the next couple of years. Now, Indian gas demand fell markedly in the first part of 2025, notably due to fuel switching in industry and refining, as global gas prices remained relatively high year on year, and as well due to lower power sector gas burn. Again, here, fuel switching is an element that comes into play. So in total, we expect India's gas demand to fall by around 1% this year, down from 10% growth last year. This is a wide spread here. We expect market conditions to turn around next year in 2026 with a return to growth across all sectors, and most notably industry, which is the country's largest demand sector. We also have expanding city gas distribution and CNG filling station networks, rising industrial use of gas, which is a fundamental trend, and growing electricity needs, which are all also factors behind this return to gas demand growth in 2026. Now, taken together, the other emerging Asian gas markets are driven primarily by another sector, that's the power generation sector. That being said, we also expect recovery in 2026 in this grouping to be supported by industrial gas demand. This marks a clear upward shift compared to recent years in terms of that industry demand boost, as improving macroeconomic conditions, more LNG availability, and overall growing energy needs in these economies combine to create this renewed dynamism in the region. Now, I think it's again worth taking a moment to discuss the supply side for these markets. Domestic production in some of these markets is facing the impacts of aging resource basins and also less dynamic activity than some had hoped for quite a while. And the chart on the right gives us another element of this puzzle. This is the share of LNG in total supply by market. India is around 50%, and what we see is that other emerging Asia-Pacific markets have been increasingly reliant on LNG as well over these past couple of years. That's that purple line that we see growing. In relatively tight market conditions, what we see is that a high reliance on LNG can condition how accessible gas is to certain buyers. And we know that many Asian markets are rather price elastic, rather price sensitive. So they would turn away from spot LNG purchases when prices are too high. And this is something we've seen in the first half of 2025 as competition for LNG volumes has remained high. So when we think about future demand growth in markets like India or other smaller emerging gas markets in Asia and the region, we need to understand the growing link between LNG supply availability and their fundamental gas demand growth. Now that we've alluded to it quite a number of times, and I've mentioned I'll come to it, I'll cover it, what does our LNG outlook look like for the rest of 2025 and 2026? That's the big question. I think this is somewhat of the linchpin when we're talking about market conditions these next couple of years. Now, on the next slide, what we see is that 2025 marks the start of the next LNG supply wave that is set to cover the second half of the decade. We've talked about it for a long time, and when we start thinking about the next couple of years, we really see this coming into action. So we expect LNG supply to grow by around 30 BCM this year. That's about 5.5%, a clear acceleration after 2 years of rather modest supply upside. In 2026, we expect a further 40 BCM of LNG to reach the markets, with the cumulative 2025 and 2026 supply upside being almost as big as the cumulative LNG supply growth from the previous 5 years, from around 2020 to 2024. Now, North America is driving essentially this supply growth, with US projects leading the way, but significant upside also coming from Canada and to a lesser extent, Mexico. Gergely has already mentioned it, but projects like Plaquemines LNG, the Corpus Christi Stage 3 expansion, LNG Canada have already begun this year and are set to continue delivering upside to the markets through the rest of this year and also in 2026. Golden Pass in the United States is also on the list of upcoming projects in our outlook here. Now, thus far, the ramp up in new projects this year has been rather successful. Volumes have ramped up quickly and without major hiccups. And this has brought new supply to the market faster than expected earlier this year when we were thinking about our Q1 outlook. Now, that being said, the market does remain vulnerable to unexpected outage risks. Instances emerged in Norway and Nigeria earlier this year. And that is a reminder that potential issues like these can easily tighten LNG supply and reduce the net growth we forecasted. Also, just a reminder that there can be outages not in LNG producing or LNG exporting markets, but there can be outages, as we saw in the East Mediterranean. When we start thinking about tightening factors for the markets, we're not just looking at LNG exporting markets. Now, to recap, the next LNG supply wave is indeed ramping up in 2025 and 2026, as we see in this slide. But we do need to look at the import side to understand just how our global market balance is shaping up. And this we'll see on the next slide right here. We're showing 3 years with three rather different underlying dynamics at play in terms of LNG imports. So LNG supply growth is accelerating, of course, but competition for this LNG is also intensifying this year. Back in 2024, Asian LNG import growth and a decline in European LNG imports broadly evened out in that year as LNG supply growth remained relatively weak. So in that period, Asia drove import growth while Europe acted as a sort of balancing market for LNG. This year, what we see is these two regions switching roles, with Asian imports falling, accommodating a significantly larger LNG take from Europe amid tighter domestic balance, as Gergely talked about a little bit earlier. That was the fall in Russian pipeline flows, increased storage filling requirements, and overall more buoyant demand. So what we see is that increased needs in Europe means that cargoes are being pulled away from Asian markets. Now, a few slides ago, we showed how LNG was at times a key balancing lever in the Chinese gas markets, and that China was a key balancing lever in the LNG market. Here is that role in action. As the world's largest LNG buyer, China is the primary element behind this downside fluctuation in 2025 that we've already seen happening and that we see continuing through the rest of this year. It's essentially compensating for the fact that Europe is driving the markets on the demand side. So the driving role and the balancing role have switched between Asia and Europe, and China is that primary factor on the balancing side in 2025. So in short, we have accelerating LNG supply growth this year. The global balance remains on edge, however, due to strong cross-basin competition for incremental volumes. 2025 marks that start of the next LNG supply wave, but it remains a transitional year in terms of overall market conditions. And we expect competition for incremental LNG to be less fraught in 2026 as time goes on. More volumes will be coming to market, about 40 BCM, we said in the previous slide, and a relatively stable gas balance in Europe is set to leave much of the supply upside to Asian and other markets. So under these conditions, the transitional phase in 2025 would give way to a more comfortable global LNG balance in 2026, with all that this implies in terms of buying conditions for more price-sensitive markets across the globe, and particularly across Asia. So this, I think we're closing out the Asia and LNG parentheses, and I can run through a few key messages here just to recall some of our speaking points from our presentation. I'll run through them quickly, but everybody can read them as well. European hub and Asian LNG spot prices averaged well above last year's levels in the first half of this year amid tighter market fundamentals. Let's recall, of course, that geopolitical tensions are also fueling additional price volatility. Global gas demand growth slowed to an estimated 1% in the first half of 2025, with growth primarily driven by Europe and North America, and in clear contrast, demand declined in the key Asian LNG importing markets. Europe's LNG imports surged to an all-time high in first half of 2025 amid stronger domestic demand, lower piped gas imports, and higher storage injections. So a tighter domestic balance in Europe, pulling in a lot more LNG. Global LNG supply growth is set to accelerate to around 7% next year in 2026. This is its fastest pace since 2019. And this is supported by the ramp up of new major projects in North America, in Qatar, Africa, and Australia as well. Improving supply fundamentals are expected to foster stronger demand growth, of course, with global gas consumption projected to reach new all-time highs in 2026. This is really this phase change from 2025 to 2026, not just in LNG dynamics, but in global gas dynamics. And finally, natural gas demand in Asia is expected to expand by more than 4% in 2026. This is supported by industrial and power sectors. And of course, underlying this is the improving supply availability that's set to unlock a lot of price-sensitive demand in that region. So thanks very much for these. Charlie, I think we'll send it back to you.
Thank you very much, Gergely and Frederick, for these insights and your presentation. I would like to pick up on a few questions that we have already received and invite you, dear viewers, to ask further questions in the chat or by raising your hand. So the first question I have for you is, which impact will the EU embargo of Russian gas have?
I think it is, first of all, there's of course the phase out of Russian gas, which would, as proposed, could be come to force by the end of 2027. I think that what is quite visible is that the Russian LNG flows can be rerouted potentially to other markets. And at the same time, this will happen already at a time when the market, the global LNG and gas market, will be already eased with the new volumes coming from the new LNG liquefaction plants. And as such, the impact on the market would be in that way moderated. Now, obviously, there are certain markets in Central and Eastern Europe which would be more impacted in an asymmetric manner by the phase out of Russian pipe gas. But these markets have already in place a good gas interconnectivity, midstream interconnectivity. They have underground storage facilities. But I think that from a supply security perspective, it might be also worth to consider strengthening further their midstream interconnectivity to the neighboring markets, in particular to those which have direct access to the global LNG market.
And the second question, I don't know if you can answer it, because I know you don't talking about prices. What is the expected price level for imported gas to Europe in the second half of 2025 and in 2026?
Exactly, Charlie. We don't provide price forecasts, but I think that the key message here is that we do expect an easing of market fundamentals, and of course, this would also mean that there would be a downward pressure on natural gas prices, both in Europe and the key Asian importing markets.
And then I have another question for Frederick. I think such a strong increase in LNG supply and all of it going to Asia sounds a bit optimistic given the current Asian story. It is possible, but it will not happen at the current forward curve price for 2026. Do you think the Chinese and India import figures are too optimistic, or perhaps the forward curve is too high?
Yeah, it's a good question. I think it's good to highlight that there are risks, of course, to our outlook. And I think our outlook outturning as it is rests on the fact that more LNG coming to the markets will not be pulled in by Europe in terms of not just in price terms, but in terms of fundamentals on the continent. I don't think we see demand growth exploding or reacting as highly to potentially low prices in Europe. And we do see a lot more sort of opportunistic buying, if you will, price sensitivity in markets across Asia. That being said, under the current forward curve conditions above $10 per MMBTU, we understand that this can be a little bit tricky, but we do expect that as LNG volumes come online, as we would expect a comfortable ramp-up rate of projects coming online, we would expect conditions to align for more LNG buying, spot buying in Asia.
Thank you. And then one question once again for Gergely. You mentioned the European gas storage levels that are currently slightly below last year's figures. If the coming winter turns out to be colder than expected, how resilient is Europe's supply system under current conditions?
Indeed. So as mentioned, current storage levels are approximately 10–11% below where they have been last year. I think that when looking at the improving seasonal spreads and the current injection rates, this suggests that comfortable levels could be reached ahead of the 25–26 winter season. Now, of course, cold winter and potentially, as we have seen, renewable power output can also have an important impact on overall gas demand. If we have a cold winter and we end up with relatively low storage levels in the spring of 26, this will mean that Europe will simply need to compete more for flexible LNG versus Asia. But I think that there is enough flexibility and liquidity in the global LNG market to deal with such a situation. Of course, this would also have an impact on the price levels and might have an implication, for instance, on the growth, on the demand growth in certain Asian markets, for instance.
Okay, thank you very much. And thank you, Frederick and Gergely, for these insights in the international gas market. It was, again, very interesting, and we are already looking forward to the next report in 3 months. Wir sehen also, die geopolitischen Spannungen, sie reißen nicht ab, ob im Nahen Osten oder auch bei den transatlantischen Verhältnissen. Aber wir haben einen steigenden Wettbewerb bei LNG und da auch gerade im nächsten Jahr steigende Mengen. Man kann also sagen, Europas Energieversorgung bleibt stabil, aber gleichzeitig auch fragil. Wir werden deswegen die Analysen immer weiter aufmerksam begleiten und freuen uns schon auf das nächste Update in 3 Monaten. Damit darf ich nochmal an Sie, liebe Zuschauerinnen und Zuschauer, meinen Dank richten für Ihr Interesse und Ihre Fragen. Die Präsentation und den Report werden wir Ihnen zeitnah im Nachgang zu dieser Veranstaltung zuschicken und eine Aufzeichnung finden Sie dann auch auf unserem YouTube-Kanal. Ich wünsche Ihnen noch einen erfolgreichen Tag und weiterhin eine erfolgreiche Woche und bleiben Sie gesund.